Hi, I'm Jimmy. In this video, we're going to walk through AT&T stock, ticker symbol T. Now, many of us dividend investors really like AT&T stock because it pays a great dividend. Right now, it's got a dividend yield of about 5.5%, and the stock is trading for about $37 a share. In this video, we're going to look at where we think AT&T stock could go. Do we think that the dividend is safe? And what could go wrong? Okay, so let's start with what has made AT&T stock so interesting lately. So a money management company named Elliott Management took a stake worth about $3.5 billion in AT&T stock. We know that because in early September, Elliott Management sent AT&T's management a letter outlining some suggestions that they have, mapping out a plan that they think will make AT&T stock worth more than $60 per share, while also securing their fantastic cash dividend. Also, they want them to do some cash buybacks. They have a pretty good plan for them. So this is a 5-year chart of AT&T stock. $60 a share would be way up here. So that's about 60% higher than the current level for AT&T stock. So here are the basics of the plan. And by the way, if you're curious to see a copy of the whole letter, I've got a link in the description below, and it's actually quite an interesting read. It's about 23 pages or so. So it's interesting if you're curious about that. But basically, they had 4 or 5 suggestions that they mapped out in depth. But to summarize those suggestions, first, they had sell non-core assets. Now, I'll dive more into some of these after we run through the basics and what it could mean for AT&T stock. Okay, next up, improve operations. Now, they're talking about mostly making operations a bit more efficient and reducing operational expenses. Then they say focus on capital discipline. And this is a big one. I'll come back to this one in a second. And this is right in line with AT&T assets. It's right in line with that whole thing. And then they have lower debt levels. And then finally, increase oversight of management. Okay, so of these 5 items, I think they're all great suggestions for AT&T, and they're really good for any company for that matter. But for AT&T, I believe that some of these are very, very important. Let's take a quick look at their debt as an example. So this is a chart of AT&T's long-term debt going back to 2004. And as we could see, we had a few big jumps. First, in 2015, that's when AT&T bought DirecTV. And then there was another big jump last year, 2018, when AT&T bought Time Warner. And as we could see, they now have over $160 billion of long-term debt. So that's a ton of debt for any company to be sitting on. So when we go back to our improvements list, well, clearly, improving the debt right here, that would be a great thing for the stock. But AT&T's debt is also addressed with this point here. So AT&T has taken on a ton of debt to acquire new companies that may not be worth their cost. And this brings us to the DirecTV acquisition. So DirecTV has lost subscribers for AT&T for 10 consecutive quarters. Now, they've also launched DirecTV Now, which they renamed to AT&T Now, but they're not doing that much for the company. At least they're not doing as much as they thought that they would. And don't forget, they spent about $48 billion on DirecTV. So the question floating around is, should AT&T sell DirecTV? One obvious buyer would be the other large satellite company, and that's Dish Network. And AT&T wouldn't even have to sell the whole company. In theory, they could sell a piece of it. Let's say they sold 60% or even 51%, and they can still participate in the upside, but you push off the responsibility of running the day-to-day operations to Dish Network. So this is one of those things that Elliott Management stressed. AT&T needs to stop going out and making these enormous purchases that are frankly somewhat difficult to combine with their current business. It's not like AT&T is doing it Warren Buffett style, where they go out, buy a company, and then let the business act independently with the backing of a much larger organization behind it. No, they're trying to mix their business right into AT&T's current business. And a good example of this is DirecTV. When they completed the DirecTV acquisition, nearly all of DirecTV's management team left the business. Now, AT&T is stuck figuring out what to do with the 30,000 or so employees that DirecTV had, and clearly they haven't done as good of a job as they could have done. So if AT&T were to stop these acquisitions and start using their free cash flow to pay down debt while also maintaining their dividend, well, what would that do to AT&T stock? So this is a chart of AT&T's free cash flow, and as we can see, it's been a bit volatile. But when we add the cash that they paid for dividends each year, we can see that broadly speaking, they seem to have been able to cover their cash dividends with their free cash flow. And we can't forget that for about 35 years, AT&T has increased their dividend every year. This is a chart of AT&T's dividend on a quarterly basis going back to 2010. And obviously, they've been quite consistent with the amount that they pay out. So this is great. And hopefully, management goes ahead and listens to Elliott Management with their business, and maybe their stock price really ends up at $60 per share. But how could this stock be worth $60 per share? Or let's pretend that they do go ahead and they listen to Elliott, or maybe they don't, or more likely, they only listen to part of what Elliott suggests. Either way, what do we think that AT&T's stock is worth today, given its current trajectory? And what if they do listen? And what if they don't listen? What is the stock worth? Well, using a discounted cash flow valuation method, it seems that given the current conservative free cash flow projections, I think it's possible for AT&T's stock to be worth in the $60 range. So here's how we did this calculation. And if you're curious, I've got a whole video on how to calculate this. I've got a template that I built, and I can email that to you if you're interested. There's a link in the description below. Plug in your email address. I'll email it over to you. But basically what we do is we take the projections for free cash flow, and then we discounted that by the required rate of return of about 8.5%. That's about my standard required rate of return, although I've used higher and I've used lower, depending on the situation. The higher we use for that, the lower the fair value of the stock would be. So in theory, the higher the required rate of return, the more conservative the estimate is. Then I used a perpetual growth rate of 2.5%, and we divide that result by the shares outstanding, and we get an estimated fair value of about $63 per share. Now, this says fair value of equity, and that's actually not correct. That should really say the fair value of the company, because what this is missing is at least some sort of recognition of AT&T's enormous debt load. Many times, if the debt is at a reasonable level, we can just stop here. We can just calculate the value of the entire company, both debt and equity, so we don't need to account for debt. But in this case, they have so much debt, it's really important. If we're just looking at the equity, which is AT&T's stock, if we're just looking at that, we need to account for that debt. So here we want to add AT&T's net debt. So we take the 459, we subtract the 171 in net debt, and we get a value of the equity of about 288. Well, we then divide that by the shares outstanding, same shares outstanding as before, and we get a fair value of the stock of about $39 per share. And this actually makes a lot of sense because right now AT&T's stock is trading at about $37 per share, so it's right in this area. Now, what I did here with these two numbers at the bottom is I really took the two extremes. In one scenario, all of their debt is in play, they keep it all, and they barely increase their free cash flow. And in that scenario, the stock would be about $39 per share. So a little bit of upside. Flip side, they pay off all of their debt. For some reason, free cash flow doesn't go up, which it really should because profits would be larger. And in theory, free cash flow should go up. But being conservative, they pay off all their debt, keep the same free cash flow numbers, and then the stock is worth over $60 per share. But obviously, there's a whole bunch of possibilities in between these two. They could sell DirecTV or a piece of DirecTV and pay off some of that debt. Or they could improve their operational efficiency and increase free cash flow at a faster pace. Or they could go out and do something crazy and make another huge acquisition, and that would be a negative thing for them, unless, of course, the acquisition outweighs it. But either way, it introduces a new risk to this whole thing. But personally, I think it's more likely that this will land somewhere in the middle of these. Having an activist investor like Elliott Management sitting over AT&T's management's shoulder, sort of peering at what they're doing, could be a very powerful thing. And I think this is a good thing at the end of the day for AT&T stock, which, by the way, has way underperformed both Verizon and the stock market over the past few years. So maybe in the next few years, this could be a positive thing for AT&T, and they'll get a shot to outperform the group. But what do you think? Do you think that AT&T stock is a good buy at this current level, given Elliott's involvement in this whole thing? Please let me know what you think in the comments below. If you haven't done so yet, hit the subscribe button, hit the bell icon. Thank you for sticking with me all the way to the end of the video. If you're interested in seeing any of the other videos, I've got links below. I've got the Excel template if you're curious. Links below. Thanks. I'll see you in the next video.